Hello, good morning, viewers, and welcome back. Today, I am going to start with accounting standards, and in the context of accounting standards, we are going to first discuss accounting standard 1, that is AS1, that is disclosure of accounting policies. Now, the first point is, what are accounting policies? Accounting policies are rules or principles and methods to adopt such principles in financial accounts for true and fair recording and presentation of financial statements. Now, point number 2, examples of different accounting policies. In this, the first one is method of amortization, AS 26. Second one is valuation of inventories, AS 2. Third one is valuation of investments, AS 13. Next one is valuation of fixed assets, AS 10. Next one is treatment of government grants, AS 12. Next one is treatment of contingent liabilities, AS 29. And the last one is conversion of foreign currency items, AS 11, etc. Now, the most pertinent question here, why AS 11? There is no single list of accounting policies which are applicable in all circumstances. The differing circumstances in which enterprises operate in a situation of diverse and complex economic activity make alternative accounting policies and methods of applying those principles acceptable. If every entity follows separate method to comply with principle, then even if they follow the correct accounting policy, but still books are not comparable, so there is need for disclosure. Now, so far AS1 is concerned, the following disclosure requirements are actually needed. Significant accounting policies. All significant accounting policies adopted in preparation and presentation of financial statements should be disclosed. Significant accounting policies means those accounting policies which deals with material issues, material items of assets, liabilities, incomes, and expenses. Such disclosure should form part of financial statements. These significant accounting policies should be disclosed at one place. Now comes insignificant accounting policies. All accounting policies relating to immaterial items of assets, liabilities, incomes, and expenses need not be disclosed. Now we are coming to fundamental accounting assumptions. Fundamental accounting assumptions form the basis for preparations and presentation of financial statements. They are usually not specifically stated because their acceptance and use are assumed. Disclosure is necessary if they are not followed. The following are generally accepted fundamental accounting assumptions. So in these, the first one is going concern. The enterprise is normally viewed as going concern, that is, as continuing in operations for foreseeable future. It is assumed that enterprise neither has any need nor any will to shut down business in near future. Next comes consistency. It is assumed that accounting policies are consistent from one period to another. However, consistency is not an excuse to adopt or to continue to adopt inappropriate accounting policies. Next one is accrual. It is assumed that revenues and costs are recognized as they are earned, incurred, rather than as and when money is received or paid. Recorded in financial statements of the period to which they relate. Next comes factors to be considered while choosing an accounting policies. The primary consideration in selection of accounting policies by an enterprise is that financial statements prepared and presented on the basis of such accounting policies should represent a true and fair view of state of affairs of enterprise as at balance sheet date and profit or loss for the period ended on that date. Secondary consideration governing selection and application of accounting policies are: number one, prudence. Prudence means anticipated profit should not be recorded, anticipated losses are to be recorded. Next come substance over form. The accounting treatment and presentation in financial statements of transaction and events should be governed by their substance and not merely by legal form. Substance refers to economic reality. And we are coming to our next, that is materiality. Financial statements should disclose all material items, that is, items the knowledge of which might influence the decision of the user of financial statements. Determination of materiality is a matter of professional judgment. And the last one and the last head is changes in accounting policies. Accounting policies can be changed if such change is required by law. Secondly, management, if they can justify better presentation and preparation of financial statements. And thirdly, by accounting standards. Any change that has material effect should be disclosed. That is all about for accounting standard 1. That is all about for disclosure of accounting policies. Viewers, I would request you to like the video, share the video as much as possible. Please give your comment. Also, please subscribe the channel and also don't forget to press the bell icon so that when I will be uploading new videos, that will be coming to you straight. With this, thank you and thank you very much.